Okay, what if I told you that the cash sitting inside your wallet right this very second is actually losing its value? Like every single second you hold it, it's worth a little bit less. I know, it sounds completely crazy, right? But it's actually a mathematical reality. Now, what if there was a digital asset created by a total ghost, a pseudonymous founder, that was specifically designed to operate completely outside of that flawed global financial system? Well, welcome to this explainer. Over the next few minutes, we're going to dive deep into the incredible origin story of a decentralized network, and then we're going to pair it with a professional step-by-step strategy for actually protecting your assets. We're breaking down the birth of digital gold and, more importantly, how you can build your very own financial war chest. Just think about your day-to-day life for a second. Why does literally everything, from your weekly groceries to your rent, keep getting more expensive every single year? Most people just assume it's because goods and services are naturally improving, but economists point to a very different factor, and that's the declining purchasing power of fiat currency. To truly understand why your money buys less over time, the sources point directly to the inner mechanics of our traditional banking system. Let's look at exactly how this works behind the scenes. So, let's break down the hidden math of your savings account. When you deposit, say, $1,000 into the bank, you probably think it's just sitting there safely in a vault, right? Well, actually wrong. The bank instantly turns around and lends out 90% of your deposit to someone else. This entire system is called fractional reserve banking. They keep just a tiny, tiny fraction of reserves on hand and lend out the rest to make a massive profit for themselves. But this creates a pretty terrifying vulnerability. What happens if everyone suddenly realizes this and goes to the bank to withdraw their money at the exact same time? The bank simply wouldn't have it. Stick around because I'm going to reveal how this exact glitch caused a complete and total meltdown of the global economy. If we look back to 2008, we see exactly where this system reached its breaking point. The housing market crashed, and because of those heavily over-leveraged banking practices we just talked about, major historical banks were literally collapsing overnight. The whole system was totally exposed. So, what did governments around the world actually do to fix it? They just turned on the printing press. They literally printed trillions of new dollars out of thin air to bail out those very same failing banks. But here is the fundamental, unbreakable rule of economics. When you print trillions of new dollars, the money already sitting in your pocket instantly becomes worth less. That is the true definition of inflation. And critics argue that this acts as a massive hidden tax on the middle class, used entirely to stabilize over-leveraged, risky institutions. But right in the middle of all that economic chaos in 2008, a totally new alternative emerged. A mysterious figure going by the pseudonym Satoshi Nakamoto published this brilliant 9-page paper on an obscure internet forum in 2009. To this day, Satoshi remains a complete ghost. No one knows who he, she, or they actually are. But their proposal was absolutely revolutionary. Satoshi envisioned a currency that belongs to the people, controlled by no king, no president, and absolutely no central bank. This was the exact moment Bitcoin was born. Now, you might be thinking, well, can't the government just ban it or turn off the servers? In just a moment, you'll understand the brilliant, uncrackable mathematical reason why it is completely unstoppable. So to make absolutely sure this new currency couldn't just be printed on demand whenever a bank failed, Satoshi engineered a massive psychological shift regarding scarcity. Satoshi hard-coded an absolute, unbreakable rule into Bitcoin's programming. There will only ever be 21 million Bitcoins in existence, period, forever. No CEO can just issue more shares, and no central bank governor can suddenly decide to print more coins. It is mathematically locked. What this means is that if you own just one single Bitcoin, you mathematically own 1/21 millionth of the entire global supply. It is an asset that literally no government on Earth can inflate away. But of course, this naturally raises a massive question. If there is no central bank and no CEO in charge making the rules, how do we actually trust this digital currency? I mean, what's stopping some genius hacker from just opening up the code, changing a few numbers, and giving themselves $5 billion? The answer to that is the blockchain. Instead of thinking of it as some magical, complicated tech word, just imagine a giant digital ledger, like a massive notebook where every single transaction is written down. But instead of keeping this notebook locked inside one centralized bank vault that could easily be robbed or manipulated, Satoshi distributed live copies of this notebook to millions of independent computers all around the world. These computers are called nodes. And here is the absolute genius of true decentralization, because everyone on the network has a live, constantly updating copy of the exact same notebook. If a hacker wants to fake a transaction and steal money, they can't just hack one single server. No, they would have to simultaneously hack 51% of all the computers running Bitcoin across the entire planet at the exact same millisecond. They would literally have to rewrite history on more than half the globe's computers before the other half even noticed. From both a computing power and a financial standpoint, it's just mathematically impossible. The network essentially secures itself. What this all means is that humanity essentially found a brand new way to store value. For thousands of years, humans used physical gold because, well, it was rare. But physical gold has a massive, glaring flaw in the digital age. Just try packing up $10 million worth of heavy physical gold bars and moving them across an international border. You are going to be stopped, aggressively questioned, heavily restricted, and taxed into oblivion. Now compare that to Bitcoin. With Bitcoin, you can move $1 billion across the entire planet in about 10 minutes, and it'll cost you a network fee of less than $2. And the best part, you can do it without asking a single person for permission. It's digital gold, but way better. And since each Bitcoin can be divided into 100 million smaller pieces called Satoshis, literally anyone can participate, no matter how much money they have. Okay, moving on to our next section, the war chest strategy, securing profits and passive wealth. So understanding the theory of digital gold, that's really only half the battle. The other half is taking emotion totally out of the equation and actually knowing how to protect your wealth once you have it. You see, when the crypto market starts climbing rapidly, people tend to trade purely on emotion, hype, and fear. To actually win, professionals use a strict, automated grid selling strategy. Imagine setting it up like this. When Bitcoin hits your first major, predetermined price target, you automatically sell exactly 20% of your portfolio. But you don't sell it into volatile cash, you convert it into a stablecoin, like USDT or USDC, which is simply a digital token permanently pegged to the US dollar. If the price climbs to your next target, you mechanically sell another 20%. You're just locking in gains on the way up. But once you actually have these digital dollars, where do you safely store them so they're protected from failing exchange platforms? Pay very close attention to this next step, because it's absolutely vital. Once you've secured those massive profits, your next move is crucial. Do not, and I mean do not, withdraw them directly back into your traditional bank account. Doing that almost always triggers massive security flags, frozen accounts, and immediate heavy local tax scrutiny. It's a nightmare. Instead, you keep your profits locked in those stable digital dollars. But, and this is the absolute most important part of the strategy, you transfer those stablecoins completely off the trading exchanges. You move them into your own personal cold storage hardware vault. This is a physical device, kind of like a USB drive, that holds your digital keys completely offline. By doing this, you have officially created a bulletproof financial war chest, sitting entirely outside the traditional banking system. Now, the real superpower of this war chest strategy becomes incredibly obvious during a market downturn. You know, what people in this space call a crypto winter. While the rest of the market is completely panicking and watching their portfolios bleed out, you're just sitting pretty on stable digital dollars, locked safely in your cold storage vault. You aren't losing any sleep because your wealth is secure. You can just patiently wait for the market to bottom out and then use those exact same funds to buy back into assets at a steep, steep discount when everyone else is absolutely terrified. It's how real generational wealth is built. But that actually leaves us with one massive, lingering question. While you're sitting safely through that crypto winter, patiently waiting for the crash to end, what if you didn't have to just sit on that cash? What if your stable digital dollars could grow automatically entirely on their own while you wait? Well, in our next explainer, we are going to crack open the final frontier of cryptocurrency, decentralized finance, or DeFi, and staking. I'm going to show you exactly how to put your idle crypto assets to work, earning high-yield interest that completely destroys the meager returns offered by traditional banks. You absolutely won't want to miss it. See you in the next explainer.